How's it going, everyone? It's Sam. I want to talk to you about something that's a little bit different today. It's something that I find really interesting, and usually I come in here and I want to talk about a stock, tell you about my opinions on it, talk to you about the company and stuff like this. But in the end, I think the whole point of investing in the stock market is eventually to be able to retire, right? Or to be financially independent, to not have to do what you don't want to do. So a lot of us get caught up in the game of, buying and selling stocks, trading stocks, all that kind of stuff. But in the end, we just want to become wealthy enough that we can do what we want to do. And some of us like playing the game and play even past when we could retire or stop working and stuff like that. But the vast majority of us are just trying to get to that point and then decide what we want to do. Now, this is something that I find really interesting. Like, this is something that I would sit down with a buddy and talk about. And I want to be clear, this is something that I am doing myself. This is something that I've considered very strongly. And it's something that I want to know your opinion about. Because I feel like we can talk about this back and forth a little bit. And you can tell me what your thoughts are down in the comments. Now, in the end, right, after you have a portfolio that you think you can probably retire, a lot of people question what that number would be. A lot of people wonder, okay, do I need 3 million? Do I need 5 million? Do I need 10 million? Do I need 100 million? Do I need 500,000? And really, it's based off of what you spend each year. So something that is a general rule of thumb is the 4% rule. So this was developed after something called the Trinity study, where they looked at a long list of years and determined that over time, if people take out about 4% of their portfolio, that they should be able to last about 30 years without running out of money. And there's about a 95% success rate. And I realize some of you guys might know this already, but I'm going to get to the new stuff in a second. I just want to back it up here for a second. And what they found was you can withdraw 4%. Now, some people are wondering, okay, well, what does this include? Is it individual stocks? No, it's index fund. So it's the S&P 500 index fund, just a collection of the 500 companies in the S&P 500. And you might be wondering, okay, why would it be 4% if they return on average, let's say 9% a year, right? A lot of people say 8%, a lot of people say 10%, 9%. Well, let's say for numbers' sake, it's 9% a year. There's 2% inflation. Well, you might be thinking, okay, I can withdraw 7. Well, not every year is the same, right? Some years, let's say you retired and then the market drops 30%. It's going to be a lot worse to take out your money right after it drops 30%. So if you had $1 million, now you have 700,000, and you're taking money out. You're taking the same amount out when it's worth less. Compared to, let's say, it goes up and doubles and then you take out, $40,000. It's not as important because it already went up. It's more inflated. So that is where that 4% rule comes in. It should kind of help you weather the ups and downs, especially at the beginning. That's something called sequence of return risk, right? Where let's say you take money out when it drops. That's really significant at the beginning of when you start taking out money. Now, the really cool thing that I want to talk about is something that is a very high interest rate. So again, generally people consider 4% because of the fluctuations in market. However, something that I find really interesting is this FIRE calculator. And before I go any further, if you guys don't mind hitting the like button, I really appreciate it. Please do that. Please hit subscribe. There's going to be a link to something down there that I think is vital to this that I'll tell you about in a second. But this calculator is based off the Trinity study. You can start here. It's called firecalc.com. Let's say you have $1 million portfolio, you want to go 30 years, you have $40,000 a year that you want to take out. This is not accounting for Social Security. Over the last 120 cycles, they looked at 120 possible 30-year periods, and they found that there's about 95% success rate, and your portfolio is anywhere from negative 400,000 to 5.7 million. So again, it's looking at a bunch of different times. The average is $1.87 million. Now, something that I find really interesting is what BlockFi is doing. And there are other companies that do this too, but you can invest in something called stablecoin. You can take a look at the risks. This is not FDIC insured because it's not a bank. This is a stablecoin. There's 125,000 that I have in my account in this. So I'm very comfortable. I've done research on it. I work with them. I have 125,000 in this US stablecoin. It's run through Gemini, which is a huge company, and they keep the majority of this on something called cold storage to keep it safe. Now, they do lend this out to hedge funds, to Fidelity, to BlackRock, to different companies that might want to use this. And they realize that they're trying to grab customers, so they're willing to lose a good amount of money on interest because they're paying me 8.6% on this right now. Now, I want to say, first of all, I'm not a financial advisor. This interest rate could go away because just like most interest rates, unless you lock it in like in a CD or something like that, they fluctuate, right? They can adjust this at any time, but right now they're paying me 8.6% here. I mean, they are paying me 6% on Bitcoin, 5.25 on Ethereum, but the thing that I find so interesting is this, the GUSD. And I like these other ones too, but GUSD is safe while I'm saving up for a house. But the interesting thing about this is it takes away a lot of the fluctuation in price. So let's say you're getting 8.6%. Let's say inflation is 2%. Well, now you can take out 6.6% for this. You can take out 6.6% instead of 4%. Now, that's really important when you start breaking down your numbers. Let's say you put $1 million in GUSD. Then you get $86,000 a year. Now, the positive is you know exactly what you're going to make. The negative is if the market goes up, you're missing out. If it falls, that's great. You didn't miss out. But over time, you might just lag behind the market a little bit. What I'm considering doing, and this is what I want to hear your opinion on, is considering, putting a decent amount of money, not my entire portfolio or anything like that, in GUSD. And you want to figure out a good way to get some normal income that pays a pretty high amount and that you can count on. A lot of people look at 6% for rental properties, but rental properties are very expensive right now, at least around me. Rental real estate and real estate in general is very, really expensive. But let's say you had a $500,000 portfolio that you want to put in the stock market. You could put the other $500,000 in GUSD at 8.6%. That would pay you $43,000. So instead of putting $1 million in the market and then getting $40,000 out in terms of your 4% rule, you could put half of it in stablecoin, cover all your living expenses, and then if you could average a 7% rate of return, so this is accounting for inflation, over 30 years, you just keep on living on the stablecoin paying you up until maybe they cut it down the line, which I would assume they would, but again, that's not the company saying that, that's just me assuming that like years down the line. You have 30 years in the market with 500,000. You're not taking anything out because you're getting all the money from the stablecoin. You would have $3.8 million after 30 years, and you would have essentially no risk of losing and going negative. I mean, your stablecoin is paying you, right? So that is something that I am considering highly. Now, there is a link down there if you want to start up with BlockFi. Like I said, I'm very comfortable with it. I have a significant amount of my money, like half of my portfolio in here right now as I'm saving up for a house. So I feel very comfortable with it. There is a bonus too. So if you sign up, you can get that interest rate. Depending on what you deposit, you can get certain amounts of Bitcoin extra. They also have other cryptocurrencies, as you can see here, Ethereum, Bitcoin. They have Litecoin, Pax Gold, some other stuff too. I just invest in these three, but I find this to be a really interesting way. I mean, if someone said to you, okay, you can have 8.6% in a savings account, that would be pretty compelling, especially when interest rates are this low. To have something that's, guaranteed at 8.6% is a very compelling argument to put your money into. So right now I'm getting about $35 a day in interest. That's pretty significant. So I want to bring this to your attention. Again, I think especially on days like this where there's so much red, I wouldn't like panic sell out of everything. I never do that and panic sell and put it in here. But, if you're looking for something compelling, if you're going to save up for something, or if you just want something that's a little bit more guaranteed or something that you can see, okay, every day I have $35 more in interest, that's something to take into account. So thank you guys so much. I appreciate it. I am really interested to hear what your thoughts are on this. I think it's very compelling from just a risk reward standpoint. But again, in the end, it's up to you guys. If you guys want to see another video on a stock that I actually really like, I'll put it up here on the end screen. And I will see you guys in the next video. Bye.